Hey, everybody, welcome to another episode of the Under the Hood podcast, hosted by Stallion Capital. Today on the show, we have Marty O'Malley, who is the president of Plan B Investments. Marty, how you doing?
I'm well, Tim, and yourself.
I am doing fantastic. Thanks so much for asking. And we love to jump right into getting to know about you, getting to know a little bit about your journey as a financial advisor. So if you could just take us through that, what brought you into the finance space and what your journey has been, that'd be great.
Okay, thank you. Thank you for the opportunity. I've been in the business 30 plus years. I came from Chicago as an ex-commodity trader. I was in the pits in 1987 when the market had its meltdown, 22.9% in one day. My associate membership at the Board of Trade, went from 100,000 dollars value that morning to 9,000 by the end of the day. The margin calls came in. People lost everything. What I realized, though I was a local trading for my own account and a few client accounts, is that we were in there selling the market as the market was dropping down, and it bounced back so quickly that we were whipsawed. Meanwhile, the institutions were up at the top ring. The pit is really not a pit. It's a set of stairs that are built up and then go down, and the locals who trade their own accounts sit in the middle of the pit and of this ring, and we trade our own accounts, making a liquidity for the market. And the institutions were at the top there. They're representing the client, the retails or the companies, and they were all buying. We were all down there selling. And what happened is all the locals were wiped out. They took all our money. And the institutions, if you look back, within 3 months, the market had come back. So everybody who was buying that day within 3 months had made a lot of money.
Mhm.
And so that told me that the institutions have the working knowledge, they have the background, they have the wherewithal, as opposed to somebody who's doing it themselves, and they have the staying power. So I lost basically everything that day. Lost, wiped me out. And I ended up answering an ad in the Wall Street Journal, in the Midwestern edition of the Wall Street Journal, for a company out of Beverly Hills that was looking for somebody with my license. At that time, there was a product coming out to the marketplace called Variable Life, and that was going to be the panacea. That was going to be the answer to everything. And they needed to stock up because it was an insurance-based product, but you needed a securities license for that. So I picked up the phone and I called the gentleman. I said, I'd like to interview for this job. I'm back to being an employee again. And they said, great. When you want to have lunch tomorrow? I said, well, I'm in Chicago. And they said, well, Chicago, we're in Beverly Hills. And I said, well, I'm answering the ad. And they said the ad was ran in the Western edition of the Wall Street Journal. But through the fates, through the universe, it ended up in the Midwestern edition. The gentleman I was talking to was from Wisconsin. He said, well, I know the work ethic of people from the Midwest, and if you're willing to fly yourself out to California, we'll interview you. And I did. I flew out. We had lunch at Carol O'Connor's place, the Ginger Man, there in Beverly Hills on Bedford. They had their own little booth with the metal plaque, and it was wonderful. It was February. It was 75, 80 degrees. Two women were going down Wilshire Boulevard in a red 350 SL convertible, window shopping at Neiman Marcus, at Bloomingfields or Bloomingdale's, or all those nice stores were right there, Saks, and they were window shopping as fast as I was walking in their car, and nobody was honking. That would be unheard of in Chicago. So I said, I've arrived. If they offer me the job, I'm coming out to California. And I never looked back.
Okay, so that's a lot of life change there. Did that happen? What was the time frame on that again? So you lost everything and then you saw the ad. What was the time that elapsed between those two things?
Probably about 5, 6 months.
5, 6 months. I
Yes.
gotcha. I
Yes.
gotcha.
And
Very
so
nice.
it was a rough time, but you pick yourself up by the bootstraps and get going again, right? You
Yeah,
have to.
no, absolutely, absolutely. And so, does that experience inform any of your practice today? Does it come out with how you talk to clients about the market? Talk to me a little bit about that.
As I went through my career, I ended up getting all the different licenses. I ended up with a 24 and a 27. and I was branch manager for a number of regional firms. And as I sat and talked to people, I explained to them, you can do it yourself, and this is what could happen, and I explained to them what happened to me, or
Mhm.
you can hire an institution and get advice, because it's not the technical analysis, it's the emotional. And if you don't have somebody to hold your hand, if you do not have somebody that you can bounce things off of, other than a spouse, somebody that's unbiased and somebody's out there that can just give you their point of view, then you may or may not do well, and chances are you probably will not.
Yep.
So I've always used that. Now, continuing forward, I was with a firm in 2003, and as a branch manager, and we'd have our monthly meetings, and they said, we want you to tell all your reps in your branch that this is the item that works, and this is what they should be selling and talking to all their clients about. And that would go along, and then maybe 4 or 5 months later, they would say, this is out and this is in. And I'd say, well, what
Mm.
was wrong with this? Well, nothing, but this is better. I said, well, it looks the same, does the same thing, both produce what we need to get done. Oh no, this is what we want you to do. Don't think, just do. And
Mm.
that had me starting to think, what was the process? What's the motivation for throwing this out and getting this? And it turns out it's all about, at that point, it was all about soft dollars. Who's buying shelf space? And I said, well, how is that being a fiduciary to the client? How is that being in the best interest of the client? And then I had a good friend, and she was a compliance consultant. And she said, you know, Marty, you have a 27. And a 20 Series 27 is that one license that every broker dealer needs. And funny how the universe guides you through. You don't know why, but when there's an opportunity and the door opens, go through it. And I did in the 90s, and now I have this 27, but I'm not using it. And she said, we can open up your own broker dealer. So I sold my house, I took my money, and I opened up Plan B Investments in 2004. And now I don't have anybody telling me what to do here. I don't have anybody telling me other than the client. And then I come to them and I say, hey, this does this and this does that. What do you think? And then I tell them why, and we weigh it out. And together, we work out a plan. There's nobody over me saying, hey, soft dollars, shelf space, whatever you think would benefit the company and not the client.
So talk to me about that concept of soft dollars and shelf space real quick. I'm not as familiar with kind of what that entails, if you will.
When you go to the grocery store and you're at eye level and they take the average height and you look at the shelf on a store, you're going to probably buy that item you see first. That's right there at your eye level. And that's the premier, the go-to shelf space, and that costs the most. The ones on the bottom pay the least for that space. The ones at the eye level pay the most for that
I
space.
see. So these products they were pushing were paying higher fees to be pushed.
No, they were paying at that point more incentives through conventions, through better advertising dollars, soft dollars, anything that
I see.
doesn't get reported.
I see. I
See?
see.
Yeah.
Okay. Okay. Yeah,
And
that's a little messy right there.
it was messy. And the industry has tightened that up considerably.
Mhm.
But back then, it was pay to play, sort of. I'm not saying, and I'm going to say allegedly because I can't prove it, but the idea of switching one to another just for the sake of switching did not make sense to me.
Yes.
So I'd
So
like to think I came out with a fiduciary concept very early on in the game.
there we go. And so then you go to start your own broker dealer. And in that time, you are, finding products for clients, seeing like, hey, which one do you want? Presenting them with the options as opposed to choosing somewhat sporadically. And so my question there is, where do you go to stay up to date with the latest market trends and financial strategies to know what to present to clients and when?
Well, there are a multitude of webinars always being offered. And it's a closed mind is a very expensive asset to own. So when I sit there and see a webinar and someone comes up with a very unique idea, I explore it, and I'll give you, for instance, alts or alternatives in your portfolio are for the right person is a great idea. And as I put plans together, what differentiates Plan B from a Merrill Lynch is I'll sit down, and one of the things I'll say, did you know you can own different ideas outside of stocks and bonds or variable annuities? There are other things out there that are available. One of them is real estate. There's a multitude of different ideas in real estate. One of them is brick and mortar. And I'll tell you a real quick story about brick and mortar. I had a really good client move from Burbank up to Paso Robles here in California, got out of lower Southern California up to the mid coast, and retired, had a fair amount of money, bought a really nice house, wanted a gentle life. Their neighbor moved in, bought the house, and cars were coming and going late at night. Motorcycles were coming and going. There were a pack of dogs out there all the time barking, and he wasn't having a great life. So I said to him, let's investigate that. And so through my clients and connections, we had some people do some background on it, and all of a sudden they're behind on their back taxes, or the back taxes were not being paid for the property. There were some nefarious people with some shady past living there. There were a number of items that said, hey, there's a problem here. So we got the right people involved, and we put enough fear of God into them to say, hey, things either you behave or the authorities are going to come in here. And middle of the night, they took off. So now the landlord had this piece of property. She hadn't received rent in 2 years. She's behind on the property taxes. And we came to her and said, listen, we'll buy this piece of property. And then she was happy, but my client didn't have the money to pay cash for that. Now they're retired, and so they don't have, they can't qualify for the loan with the income from retirement they needed. And I came up with the idea of using their IRA money to buy this house, and they bought the house with their IRA money, and now that's an asset of the IRA. And what do you know? They've got a great life now. They got nice renters in there, and they control it.
Did they have to self-direct it, or were they able to just go straight through the IRA?
Well, it's a process. There are only a few unique custodians that will hold an asset like that. A Schwab or a Fidelity will not, but there are people out there, and there's always an answer. I'm a big believer in that. There's an answer out there, but you just have to find, and it may cost a little bit more to have that type of custodian, but there are people or custodians and firms that will take care of that. And so they self-direct it. I'm involved, and as a team, we make sure that they're within compliance, because there are certain unique rules about having different types of assets, non-traditional assets inside a qualified plan.
And did you learn about that self-directed from a webinar, or was it from something else?
Actually, I did. The company is very strong in marketing, and somehow you get on the list, and every day I can listen to a webinar. If I had time, I could listen to 2 or 3 a day, but we try to listen to a couple a week just
Yeah.
to see what's going on.
Yeah, nice. Absolutely. Absolutely. So you like to approach business with an open mind, and that allows you to source opportunities, various alternative opportunities, as well as other kind of financial strategies from these webinars you go to, and then just staying up to date with all the other kind of market resources, if you will, as well. Is that accurate?
Absolutely. Change is the constant in life, and things are not always, if you're going to be stuck on an idea and have a closed mind, life is going to pass you by. The market's going to pass you by. Opportunity is going to pass you by. And so you need to have and listen, and you don't have to subscribe, you don't have to believe, you don't have to drink the Kool-Aid, but you need to figure out why. Think Socratically. What's going on here? Why is this being presented? What is unique about this?
You mentioned alternatives here. So this is a section of the podcast we love to jump to. So let's go ahead and jump right to alternative investments. When you're on these webinars or you source these opportunities from, wherever you do, how are you going about evaluating alternatives? What are some of the criteria in your head, and what are you really looking at?
Well, the risk is huge, so we need to know what the downside. Worst case is, I think Dale Carnegie said, determine the downside. What's the worst case scenario, and then everything else makes sense from there. And so you need to know what's the worst case scenario in the downside. Is it a time frame that the money will be tied up for? Is it a currency risk? Is it a credit risk? Uh, how is the credit worthiness and the background of the people? Real quick note, early on in my career, when I first came out in California, I had somebody from Las Vegas who was a big movie producer and strung me along, and it was a tough lesson. And he actually said he had a script and he was putting this all together. And bottom line, he was one of the biggest cons out there. Yet he sucked in a lot of people, and he was using me as I was his money guy, unbeknownst to me. But he sucked in a lot of people and then disappeared. And
Mm.
but people want to believe on face value. And at that time in the 90s, there were some large name individuals, actors, who got sucked into it. And when the police came knocking on my door, think because all his paperwork said I was the person, I showed him all the paperwork that I was given. I said, I'm just his financial planner. But
Yeah.
so you have to do your due diligence. You have to know who you're dealing with, and you have to source, and you have to check, check, check. Trust but verify.
Trust but verify. I love it. So not only are you assessing risk from the investment vehicle perspective, but you're assessing risk of the individual you're dealing with. You need to know that you can trust them. You need to know that there's some accountability there, and then be able to verify all that as well.
That's right. If there's a red flag, there's a reason there's a red flag. If there's a pit in your stomach that says there's something wrong, you got to go with your gut.
Yeah.
It's just there's too many options out there. What's the old expression? There's no second first introduction. So,
Yep.
okay. So, you have to put your best foot forward, no matter who you are or what you are.
I love it. Well, so after you assess the risk of an alternative investment, are you looking at upside next? Are you jumping to, do I understand the vehicle? Kind of talk us through that process.
Well, absolutely. If you cannot explain something in 3 sentences, my belief, then there's a problem.
Mm.
Okay, that's the old rule. You ask a question in 3 sentences or less. If I cannot understand it, and I'll admit right now, I'm still having a problem with crypto, and no one's been able to, in my definition, answer that, describe it in 3 sentences or less.
Yeah.
And so I want nothing to do with it. That's outside my comfort zone because I want to sleep at night. If I'm making recommendations, I want to know that I'm behind it. So, what we want to do is be able to thoroughly understand it. People, most people, uh, want to make money. All people do not want to lose money.
Mm.
And they don't want to lose money, do not want to lose money to a con. Okay, so you
Yeah.
can lose money to market exposure, but if you lose money to a con, that's there's no coming back from that.
Completely understand that, and understanding the vehicle, being able to trust and verify the person, those are two very important things to that. Now, I will say with crypto in specifically, we had somebody on the podcast recently. His name is Keith Laska, who kind of does a lot of stuff with Bitcoin, and he has some courses on Bitcoin, if you will. So, maybe, if you want me to, I can send you his website link after the show. It was, it'll be posted right before yours, but yeah, no, I would love to. Hopefully he can explain it in a way that makes sense to you. But if you've tried, I know you're an open-minded guy, so maybe not. But
I'll listen. I
there
will
we go.
listen. But I'll say this: there's a reason that FINRA, Financial Industry Regulatory Authority, who I'm a member of, comes down on me and asks me a whole set of questions about crypto. And if
Mm,
you answer yes, you have about 25 other questions you have to answer. So if
Yep.
I'm involved with crypto, they want to know everything that I'm doing.
They're
So
just trying to trust and verify, right?
there you go. Thank you. Absolutely. Yeah. Yeah.
No, for sure, for sure. Well, and what's interesting is I think part of Keith's shtick is it can be continuing education for
Hmm.
financial advisors, and so maybe there's some interesting correlation there, specifically with the FINRA stuff. But enough about Keith. I want to get back to you and kind of how you look at alt. So we are trusting and verifying the person. We're making sure we can understand it in 3 sentences or less, and then of course there's that upside portion. But I'm curious about what role you feel alternatives play in a portfolio.
For larger portfolios, for accredited investors, it's certainly something that needs to be out there. And for two reasons. One, it just makes sense. More diversification is very helpful. Non-correlating assets are great. Two, if I'm not offering it, my little BDs like Merrill Lynch will be offering it. Now, I'm not saying I'm competing with Merrill Lynch. They can go after the whales. I'd rather have 1,000 minnows than 10 whales.
Mm, yeah.
And a lot of my people will be very skeptical or very unsure unless I'm very sure about it. Now, I would come in but I need to offer it because if I'm not, they can go down to the guy down the street, and the person down the street may be offering it. So I need to have that in uh, that arrow. I need to have that available in case that comes along. I don't have a research department. I need to rely on more of people that puts the products together. I need to rely on my ability to understand what is being put together.
That makes a lot of sense. And so, specifically, when you're looking at accredited investors, larger portfolios, it's making sure you understand it, making sure that the client can understand it and have confidence in it because you do. And then for the specific role, is it primarily an accumulation play? Is it more of an income play in their portfolio? Talk to us about that.
I would I use it as a non-correlating asset.
Mm,
So, I mean, anybody can buy stocks and bonds. There's how many different mutual funds out there, ETFs, and they all, the majority of them own the same basket of stocks.
yep.
It's just how they trade it. So they all have their methodology. But if the market dropped like it did in October 1987, the whole market's going to go down no matter what you have in your portfolio. And what we're doing with the larger portfolio is having a portion, not a big portion, just a piece, non-correlating.
Yeah.
And that's what I like about it.
And when you say a piece, is that more 1%, 5%, 10%, 20%? Kind of what's your, not strict guidelines, but initial thoughts as a general guideline?
Comfortable guideline, probably overall total would be 10% or less.
10% or less, for sure. And are there any alternatives that you find interesting and that you want to learn more about for 2024? I know we already kind of mentioned crypto, but I wanted to give you an opportunity to speak to any others.
Real estate. Real estate's a sound asset. They're not making any more land, and so the idea of real estate in some form or fashion is probably something that should be part of a portfolio. I'm not sure how or where or what, but it somehow it needs to be involved.
Yeah, yeah, no, absolutely. And then, of course, there are various types of real estate. You know, there's syndication, there's development, there's real estate debt funds like Stallion. Are you partial to any of the types that you want to learn about, or is it more real estate in general, how it fits into a portfolio?
Top down, I would think we'd want to learn with the client. And real estate's not for everybody, but it's for a lot of people.
Yeah.
And the majority of people say, and the more sophisticated they are, the more they want to drill down into the different types. So simply, you could buy a REIT if you need to put a REIT in there. But I think there are some good ones out there, but there's better ways to do it. I think
Yep.
the old-fashioned model, tie it up for 10 years, high fees, may not be the way to go going forward.
Mm,
It's worked in the past, but um, going forward, things are changing so quickly. Why would you tie something up for 8, 9, 10 years? So, but I have people that are very much hands-on with real estate, and then they really like to get down there in the nitty-gritty and say, "Hey, they'll look at debt, they'll look at real estate debt, or as opposed to just a brick and mortar, they want to look at maybe some development. Maybe they'll look at, and my job is to bring that to them to assess: is this the type of person this makes sense to?"
I love how everything is so client focused with you. That is the way to be because you're that fiduciary. The whole thing is built on trust. So I know we talked to Alt a little bit. Let's jump to the current market. So you said about 10% typically, maybe more, maybe less, depending on the person, can be in alts, but the rest is, the equities market, stocks, bonds. And so what factors are you really taking note of for 2024 and going forward? What are the most important factors, and what's your high level strategy to address them?
In the past, buy and hold rebalance seemed to have worked. It In the past 5 or 8 years, it I don't know if interest rates have been used as a chess piece, as a pawn, and as interest rates have been moved around. We saw what happened the last 2 years, and people were really beat up with interest rates. When you have a portfolio that's 40 or 50% in debt, that hurt.
Yeah.
And all of a sudden things level off, and it came back. And I hear that. I hear, in fact, Harry Markowitz. I'm just looking at my book over here. You recognize that name? Harry
I do not
Markowitz.
know.
Harry Markowitz won the Nobel Prize back in '56, I think, for buy, hold, and rebalance. And
Mhm.
so he came up with that strategy. And I heard him speak at some seminar, and I was wowed from it. And I think this is 15, 17 years ago. I was amazed by him. And I actually got up as he walked off the stage and he went to the back of the room. I walked, when I met him, and I said, "I want to buy your book. Where's your book?" He said, "I don't bring any books to sell." He's just one of these intellects. And I said, "Well, you should have a table here full of books and you should be signing them." He said,
Yeah.
"Well, I live down in San Diego and I was in LA." He said, "You want to come down to San Diego and buy me lunch? I'll sign your book."
Mm.
I waited a couple weeks. I called him. I said, "I'm going to be in town." I went down there, had lunch with him, bought him lunch, and he signed my book. And his methodology it worked for buy, hold, and rebalance in a normal market. But when we start having these wild swings as our debt hits $34 trillion, as things are a little more shaky as they were years ago, I'm thinking, does buy, hold, and rebalance still work? Well, to a certain extent, yes. But what's happened in the past year? Person of the year, in my opinion, nothing against Taylor, person of the year should have been AI. Should have been AI. Okay, should have been
Uh,
right there in Time Magazine. AI. Okay,
yeah.
but that's my opinion. All the Swifties don't hate me. Okay, so,
That was amazing. That was amazing. We're probably gonna get a little hate for that one, but
really, okay, I'm used to it. Uh, so I've got daughters. I'm always wrong. Okay.
I gotcha.
Yeah.
I gotcha.
So, but AI is changing the market, and tactical is becoming a thing of the future, if not
Yeah.
today, of the future. And so maybe we not only diversify assets, but we diversify methodologies.
Mm.
Okay, so some will be buy, hold, and rebalance, some will be tactical, and then some will be in alts. And so you kind of spread it out a little bit. So you get many layers of diversification.
Yeah. Yeah. No, absolutely. And when you say tactical, can you elaborate on that a little bit for those who may be unfamiliar with that term?
Well, so you have the buy, hold, and rebalance. So that would be a portfolio. Let's just simply put 50-50, 50 stocks, 50 bonds. And as one goes down to 40, the other one goes to 60 because it has to equal 100.
Yep.
And someone needs to sell the 60 to get it to 50, and someone needs to buy the 40 to get it back to 50 because that's your risk tolerance that the client told me. So
Yep.
we're back to 50-50. And then so the idea is that market that went down to 40 would appreciate in the future, and then that's how you make your money. So someone needs to monitor that. Well, that worked, but what's happened in the couple past years is that bonds went way down. So they went down from 50 down to, let's say, 30 in that portfolio. And then, but whatever happened to stocks, they were going down.
Yep.
Okay. So it kind of stayed 50-50 at a depressed level. There was no way to, there's nothing else to go to. And had you had alts in there, then some of it would have been rebalancing into alternatives. But that's buy, hold, rebalance. And so that kind of works in a stable market, in a stable interest rate environment, or in a declining interest rate environment. That's wonderful. In a rising interest rate environment, not so good.
Yep.
So that's buy, hold, and rebalance. Tactical is actually someone moving in and out of the market or moving in and out of sectors of the market. And so what we saw in the past year is that tactical people were moving more, especially the last 12 months, into the tech stocks. As the year before, tech stocks were terrible. I think it was Meta was down at one point. Meta was down 74% the year prior, and then all of a sudden last year came roaring back.
Yep.
But okay, so someone was moving. They're not necessarily getting out of the market, although that's an option. They'll move from one sector, like a value sector, a value stock, into a tech stock that's with AI. And so tactical is you're paying someone to see that and move that. So doing it without emotion. See, if we use a manager, there's no emotion involved. People that do it themselves, they sit there and they hold their hands and they ring them and they stay up at night. And should I be buying Meta on the way down here? A lot of people won't. And here, I'll give you an example. Are you buying Disney right now? I mean, look at Disney.
Yeah. Yep.
Okay, that's a
Yep.
tough one. Are they a takeover candidate? I don't know, but they seem to have some problems, and but
Yep.
that emotional tie keeps you from acting. So those are the different types of methodologies.
No, that makes perfect sense. Thanks for elaborating on that. And I guess the kind of reframe in your portfolio construction of, okay, we're going to have kind of buy, hold, rebalance, we're going to have tactical, we're going to have alternatives. That's really how you're addressing risk in today's market, given that kind of increasing interest rate environment we've had over the past couple of years. Is that accurate, or is there another way you're thinking about risk as well?
Well, you need to be diversified. So you've not only are you diversified with the stocks and the bonds and the buy, hold, and rebalance and the stocks, or just giving the carte blanche to the manager to be tactical, but you also have to have another category is in the bigger accounts to have some alts in there, alternatives, and so because that's non-correlating. So what you're trying to do is have so you have the buy, hold, and rebalance and the tactical are somewhat correlated because they're in stocks
Yeah.
or they're in debt instruments. But the alts are different, so they're not going to be. So that would be the more of the long-term, steady type of. I can count on that being there. It's not liquid like the other two, but it's there, and so it adds a balance.
Yeah, I mean, I think that's a great way to kind of think about it, and specifically that non correlated piece. And now I do want to jump. I feel like we've covered kind of current markets pretty well, what a portfolio construction looks like. We touched on alts, we touched on your past, but now I kind of want to jump to your firm specifically and what you think is most important to the ideal client advisor relationship.
I always tell people I'm the world's worst salesman. Marketing is not my forte. We're out there getting word, trying to put ideas out. I'm competing with the Merrill Lynches of the world, and they've got unlimited budgets. My client base comes from referral, and I'm very hands on. So I tell people when they come in, you have to have skin in the game. I'm not chasing you. If you want to do this, I'll do it. And I'll go from soup to nuts because we'll sit down and we'll look at everything. We're going to look at everything from your investments to your will and trust to your insurance to your long term goals to your obligations to your mortgage. We're going to look at everything. And right now, I'm talking to people, especially in California, about their homeowners insurance. Do you have flood insurance? Okay. When's the last time you increased your homeowners insurance because the inflation has driven up the cost of replacement? Do you have a
Mm,
replacement on your policy? So I talk about all of that. I get into the wills and trust. Do you have a will and trust? When's the last time you looked at it? How come you haven't changed it in a number of years? How come you haven't updated it? So we look at and everything. So I'm involved with hands-on with everything. I do have people that say, "Okay, call me once a year." I have people that say, "Call me once a month."
yep.
But right now, I'm in the middle of tax season. I've got a fair number of people say, "Will you come and sit down and help me gather my taxes?"
Yeah.
And so I sit there and I get all the 1099s and whatever they're missing, we find and we put it all together.
Yeah. So really the most important part for you is just that hands-on nature to the relationship and, just being able to be there for people in a way that some of the bigger guys, they aren't talking to you about your homeowner's insurance necessarily or sitting down with you to do your taxes like you maybe. Is that right?
Correct. Absolutely. It, it's tax season, and in conjunction, because the number of people, as my book gets older, people are passing on, and I had one surprise about 2.5 years ago that the will and trust was not updated, and something from 20 years ago took precedent over their wishes today, and
Ugh.
so now I talk to everybody. Got to
Yeah.
have that in place. That's a very important document.
Yeah, for sure. And would you say that's the most unique part about your firm and what really sets you apart from other advisors? Or would you point to something else when somebody asks you that question?
No, just being very involved with my clients. I don't need to watch TV. I have drama going on all day, so I think I don't watch. I watch maybe something once in a while on TV, but
Yeah,
literally, at the end of the day, I don't need any more fake fictitious drama
I
written
got it.
by Hollywood. I see it. I see real life drama all day.
I love it. That's so funny. And it's cool that you are, you know, drama is not always the most fun thing to be a part of, but I love that you walk through it with your clients. And,
Mm.
that relationship is just key. So, Marty, I think that is all we have for you on today's show. Is there anything you feel like you want to talk more about or anything you want to leave the audience with, or you feel good to go?
No, I feel that if the takeaway for anybody today should be whomever you're working with, make sure that you cover everything. It's
Mm.
the investments are just a portion of a financial plan, and so sit down and document. To the extent that even when you're traveling overseas, you've got a contact at home that's somebody that can handle your money, that you've got a way. Real quick note, I had a client who go to Australia and move down there. She called one day. I got this letter, a handwritten letter in pencil saying, "Please liquidate my accounts and send it to this bank." And of course, I took the letter and I stuck it aside. And 4 months later, this lady shows up at my door, and she said, "I've never met you, but I bought a book of business and prior to her leaving, and I never met her, and she came and said, 'I'm so and so.' I said, 'Well, prove it.' She showed me who she was. She said, 'Did you get a letter?' I said, 'Yes.' She said, 'Did you liquidate my account?' I said, 'No.' The little account I had. The big firm she was with liquidated her account. They got a letter too, and they liquidated her account, and it was some bad people down there, down under. I mean, they got a hold of
Oh,
her money. Okay, so you got to have that relationship. And when
yeah.
my people travel overseas, they give me a code word, and so if they need money, they have to have that code word. Okay,
Yep. Yep.
you want that. That's what you're paying for. Get what you're paying for, and know
Mm,
what you're paying for. And if you just want somebody that does investments, that's fine. But know what you're paying for.
yeah. No, absolutely. Get what you're paying for and know what you're paying for. Marty, if people want to know more about you, if they want to find you, where should they go to do so?
Plan B Investments Inc. Or planbinvestments.com, or telephone numbers 888-511-4611.
Perfect. Well, if you guys are listening to this first, Marty, thank you for coming on the show. It was a great interview. I appreciate you.
Tim, thank you for the opportunity. I really look forward to working with you.
Of course. And if you guys are listening to this and you loved what Marty had to say, you want to check him out more, all the links to do so will be down in the show notes. It'll also be on our webpage, stallioncap.com, where we feature this podcast and in all the comment sections of all of our social media posts about this wonderful conversation with Marty. Thank you guys so much for watching, and we will see you guys on the next one.